Let us learn about some words used in mutual funds. First is, what is assets? Assets are the things that make your money grow, generate income or increase value over time, like real estate, gold, stocks, bonds too. What is equity or stock? Stock is equal to share. So when you buy stocks, you own a share of a company. If the company does well, the value of your ownership or share price grow up and you make money from it. What are bonds? Bonds is nothing but you basically giving a loan to a company or government. Then what is your return? Return is equal to loan plus the interest. So what are money market instruments? It's basically lending money to the government, company or bank for a shorter period of time. Like say a 1 day, 3 months, 6 months and 12 months, etc. Now what is debt instruments or investment? It's nothing but investments in bonds and money making instruments or in any one of them. Example, commercial papers, certificate of deposit, treasury bills and repurchase agreements or repos. म्यूचुअल फंड्स, क्या म्यूचुअल फंड सही है? म्यूचुअल फंड्स इज नथिंग बट a pool of money invested by investors like you and me, and it is managed by professional fund manager. And the fund manager invests in stocks, gold, money market instruments, bonds, real estate as per the scheme. Now mutual fund classifications. First classification based on structure. It's either open-ended or closed-ended schemes. Open-ended. In open-ended you can withdraw your money any point of time. And closed-ended schemes you cannot withdraw your money anytime soon. Second is management style. It is either active or passive. In active, the fund manager is involved actively in decision making and tries to outperform the market. He has to think when to buy, hold or sell as per the market conditions. And the passive one, he simply copies a benchmark index. A fund manager invests on all the stocks which are in the index. He tries to copy the index where there is no much thinking about it. What is index? Index is nothing but a list of stocks that represents a particular market, acts like a reference for performance of market. Example, BSE Sensex, nothing but Bombay Stock Exchange Sensitive Index. So sensitive index, Sensex. It's a performance of the top 30 companies listed on the Bombay Stock Exchange. Example 2 is Nifty 50 Index, which represents the performance of the top 50 companies listed on the National Stock Exchange of India. Third is investment objective. Either it is growth oriented, which invests in equity, or in liquidity, where it invests in debt, or tax saving, where it is invests in equity, and or income generation, where it primarily invests in debt. Now, what is Security and Exchange Board of India? SEBI is the regulatory body for stock market in India. Coming back to categorization of mutual fund schemes by SEBI. Now, it is divided into three basic schemes, that is equity schemes, which primarily invest in equity. To qualify as equity, it should invest more than 65% in stocks or equity. Next is debt schemes. It invests in bonds, money market, etc. And the hybrid schemes. It's nothing but a mixture of equities and debt schemes. Now, equity schemes. Equity schemes are divided into three categories, that is large cap companies, mid cap companies, small cap companies. Large cap companies have capital of more than 20,000 crores, whereas mid cap comes in the range of 5,000 to 20,000 crores and small cap less than 5,000 crores. So large companies have a stable and slow growth but low risk. Medium companies are volatile in nature but they have medium growth and medium risk. Whereas small companies are highly volatile, they are fast growth but very high risk. Now coming back to what is actually cap. Cap is nothing but capitalization. So it's nothing but the total number of shares of all the shareholders and the current market price. Example, if you have if you are having 10,000 shares together of all shareholders and market price is 100 rupees, then you have market capital of 10 lakh rupees. Now equity funds categorize as per SEBI. First is large cap funds, which invest at least 80% of investment in the large cap stocks. Large and mid cap, at least 35% invest in large cap and 35 in mid cap stocks. Mid cap funds, at least 65% investment in mid cap stocks. And small cap, at least 65% investment in small cap stocks. Flexi cap fund, at least 65% is invested in equity, either large, mid, or small cap. Here, the fund manager dynamically changes according to the market sentiments. Next is multi cap fund. Here, at least 75% is invested in equity, but do care here, at least 25% to be invested in large, mid, and small cap each. Coming back to debt schemes. Debt schemes based on two categories. First is duration. If it's a short term fund, then it is for 1 to 3 years, mid term for 3 to 4 years, and long term it is greater than 7 years. Second is the issuer, or basically who wants loan, a government or a company. Gilt funds is basically used by governments to get some money from the public. Corporate bonds, it is used by the private companies to get money for their machinery or to buy something or for their investment purposes. And the treasury funds, it is again loan taken by the government. Hybrid funds are nothing but a mixture of equities and debt instruments. So type of hybrid funds: conservative hybrid fund, maximum 25% in equity and the remaining debt instruments. Balanced hybrid funds, to maximum 60% investment equity and the remaining debt instruments. Aggressive, it's nothing but 80% maximum investments in equity and remaining in debt instruments. So as you can see, from going from conservative to aggressive, the equity proportion in investment increases. Going for multi-asset allocation fund. So in this, investment is done in at least 3 asset classes with a minimum allocation of 10% each asset. The assets can include debt, equity, gold, etc. Coming to dynamic asset allocation or balance advantage fund. Here investment is done in equity and debt, that is managed by fund manager dynamically between equity and debt. Here the maximum investment in equity is 60% and rest is in debt. Coming to then index funds. Index funds creates a portfolio that copies a market index. As we have seen earlier, the stocks included in index funds are the same as that in the index being followed. Yeah, so index fund stocks is a copy of, example, let's say Nifty 50 index stocks. Then exchange traded funds, ETFs. These are a fund that tracks an index or baskets of assets like an index fund. It is unlike regular mutual funds. A ETF trades like a common stock on stock exchange. ETF held units are held in demat form and they are passively managed. So popular example is gold ETFs. So coming to equity linked savings scheme or ELSS. ELSS is a tax saving scheme. So tax reduction is given under section 80C. It's a tax saving mutual funds in India, but it has a 3-year lock-in period. So that means you cannot withdraw for 3 years. Coming to funds of fund, FOF. FOF are the mutual fund scheme that invest in units of other schemes of the same mutual funds or other mutual funds. It simply says that it's just a copy the investment style of the other mutual funds. Like fund A is copying the style of mutual fund B. Another is international funds. International funds are investments made in markets outside of India. Next is solution oriented funds. Solution oriented funds like retirement fund, where there is a lock in for at least 5 years or till retirement age, whichever is earlier, or children's funds where the lock in is at least 5 years or till the child attains age of majority, whichever is earlier. Coming to net asset value, what is it? That is the cost you are paying when you buy a unit of mutual fund scheme. Since mutual funds are linked to markets, so NAV of a mutual funds varies day to day, just like stock. But the NAV of mutual funds are declared at the end of each day after markets are closed. Now, what are the expenses involved? The cost of for running and managing a mutual fund scheme is called total expense ratio, that's TER. So TER for equity mutual fund is between 1.05 to 2.25%, and a debt mutual fund is zero point 0.8 to 2%. The displayed NAV of a mutual fund is after deducting the expenses. Now, what is a direct plan? Investing in mutual funds directly without involving any distributor or agent. Since there is no intermediary involved, so NAV is always less and the cost is less. And what is a regular plan? Investing in mutual fund with the help of a mutual fund distributor or an agent. So since distributors or agents are involved, the NAV is more. Typically, a direct plan will have less NAV compared to regular plan, mostly maximum by 1%. How to invest in mutual funds? So you can invest in mutual funds through online websites of individual mutual funds using online platforms on stock exchange like Zerodha. For direct plan, in the website of mutual fund, you have to make ensure that you select the direct plan. And third is using SIP, very popular instrument, uh, that is called systematic investment plan. That is nothing but investment through smaller installments. And the last is using lump sum investment. Coming to taxation as on 2024. First, let us see what is capital gain on equity funds. So there is a long-term capital gain. If you are selling a mutual fund after 1 year, if you are holding for 1 year and selling after that, that is called long-term capital gain. And for short-term capital gain, if you are selling a mutual fund units before 1 year. The taxation of equity funds. The taxation of equity funds, first, if it is a long-term capital gain, it is taxed at 10% on gains exceeding 1 lakh. Say example, you invested 10 lakh rupees and return is 12 lakhs, so the gain is 2 lakh rupees. But you will be taxed only on 1 lakh, that is out of the 2 lakhs, since 1 lakh is exempted. But if it is a short term capital gain, you're taxed at 50% on gain flat, irrespective of your income tax slab. Now, taxation of debt mutual funds. So, it is only a short term capital gain irrespective of holding times. That is, there is no long term capital gain. Everything you withdraw after some time, it is considered short term capital gain only and is taxed as per your income slab rate. Let us now clarify some of the myths. Myth number one: only experts can invest in mutual funds. The fact is, even a kid can invest just by understanding mutual funds. It's so simple and easy. That is the essence of it. Second is, a mutual fund scheme with lower NAV is better than investing in higher NAV for other mutual fund. So this is generally people go wrong. So let's say you take an example of 10,000 rupees you want to invest. So let's say scheme A NAV is 20 and scheme B NAV is 100 rupees, and they both schemes invest in the same portfolio of stocks. So let's say then you will get 500 units for scheme A and same 500 units for scheme B. You should divide the invested amount with the NAV and say both have increased its value by 10%. At the last you will get in each case 11,000 rupees only. So it depends upon the number of units you purchase, not on the NAV rate. Third is, mutual funds are only for long term. It's not the scenario, but if you keep for a long term, it's very best. But there are very short term schemes where you invest in a very few days, few weeks, and few years also. Mutual funds invest in stock market only. Mutual funds invest in bond market, corporate bonds, government bonds, and money market instruments like treasury bills, commercial papers, or CDs. So no, it doesn't invest only in stock market, it invests in debt markets also. Whether we need a large amount of money to invest? No. As per today, you can invest through SIP, systematic investment plan, with as little as 100 rupees or 500 per month. Scheme with higher NAV has reached its peak. So we just generally think that if it's a higher NAV, that means that scheme will not perform further. It doesn't mean that the fund is expensive. Higher NAV just indicates a good performance of a scheme over the years. Buying top rated mutual fund guarantees better return. No. Mutual fund ratings are based on past experiences, performances, and are subjected to market fluctuations. A 5-star fund now today may become 2-star rating or vice versa over a period of time. So we have to watch for it. You have to need to have a demat account to invest. Demat account is not needed for most of the mutual funds except for exchange traded funds. So that's all for today. Kindly subscribe and press the bell notification for personal finance manifesto. Thank you.